Hi everyone, Ryan here, Ion Capital Solutions. Hope you're doing well. Today I want to talk to you about loan positions. There seems to be misconception out there in the marketplace amongst borrowers and brokers that if a client has existing loans, that they can get a better loan than the current loans they have. That is absolutely not correct. That is not possible. Okay, so what do I mean when I say this? What are the correct expectations that the client should have? Well, let's talk about it. Okay, so please understand when a client has multiple positions, okay, meaning multiple loans, right? So the first loan they took was the first position, the second loan they take is the second position, the third is the third position, whatever it may be. And only if loans are active are they right lining up. Obviously, if a loan's paid off and then they take another loan, that's a first position, not a second position because they paid off the loan. But the point you have to understand here is loans and rates that they're determined by risk, right? The lender's essentially going to put them through their underwriting procedure, right? Calculate affordability, present an offer that they think that they can afford. If they still have that loan and now they want to take another loan, a second loan behind it, the terms are not going to be better. It's not going to be a larger loan amount. It's not going to be a better payment frequency. It's not going to be a lower interest rate. It's not. If they want to pay off an existing loan with a new loan, use part of that money to pay off. The most they can use is 50% of that loan to pay off their existing balance, and then net the other 50%. Sure, they can do that, but the loan's going to be something similar to what they just took. So understanding these things and not over promising and under delivering with your clients is going to make all the difference. So let's dive into this topic a little bit, because a lot of brokers make mistakes here, and there's a lot of clients out there that have been led to believe otherwise, and so they're really troublesome clients that are hard to close because they're just under a misconception. They have a unrealistic expectation. So with that being said, let's discuss loan positions and make crystal clear one more time. There is no such thing as a less expensive next position or consolidation. It's not going to happen. Get it out of your head. Don't believe that it is. Don't allow your client to believe that it is, okay? Unless the client wants to eject cash out of equity from a piece of real estate that they own, that they utilize for their business, right? Then we can get them probably a single-digit interest rate, whatever it is. So there is one exception to the rule, okay? But not every client has significant equity in a piece of real estate that they utilize for business that they can eject cash out of to be able to pay off their loans. Likely, if they had that route, that's the direction they would have gone with to begin with, instead of taking a unsecured loan like a cash advance, right? So keep that in mind, okay? That being said, understand that more loans means more risk, and risk determines rates. So anytime you talk to a client with existing loans and they try and talk about something better, change the conversation immediately, correct them. Help them understand this positions you as the expert. It also sets realistic expectations to cater to the client and say, oh, I'm so sorry you had a bad broker the last time and the lender wasn't good and it was too invasive and it was too expensive and you're unhappy, and work with me, I'm better. You're setting yourself up for a fall immediately. Be honest and straightforward with the client and help them understand what's to be expected. If they don't like that, well, then it's not a good client. Move on. But over-promising and under-delivering is not going to work out. You're going to end up with time spent and an offer out that went out the door that doesn't go anywhere. They don't take the money. You have to set realistic expectations. Even go as far as to say to the client, hey, if you want to have unrealistic expectations is what is available to you, and you want to shop your credit around and damage it because somebody told you something that's not true, and that seems like a good idea to you, then good luck. But if you want somebody to help you, tell you the truth, and get you what you need and get you on the road to recovery, I can do that for you. And make clear, right? You can go with me and I'll be honest with you and I'll help you. Or you can go searching around, ruin your credit, because you're never going to get what you want. You have to be willing to be tough with your clients. They'll respect that. Or they'll get off the call, in which case you just dodged a bullet. But the other road leads to nowhere. I can guarantee you that. So Please also understand when compounding interest and how it works, okay? Though clients will frequently pay off in net additional loans, meaning if they have a loan for $50,000 and they're paid down to $25,000 or $20,000 in the repayment of the loan, and they want to take another loan, right? They qualify for 50K, they want to take half of that loan, pay off their existing loan, and then net the rest of the capital and inject it into their business. Yes, we can help them do that, and that's them basically just continuing on the same path that they were on. But please understand that the reality is it doesn't make sense for clients to pay off loans with loans. It's just more debt. And if they have existing debt and a loan that they want to pay off with an even more expensive loan, the interest is just going up. The debt is just going up. This is not a good idea. This is a bad idea, right? So help your clients understand this. And you should understand this as well, and set realistic expectations and understandings. You want to help businesses. Businesses need to grow, right? And understand if a lender is going to have an interest in a client or not. If a client's in this pattern of borrowing and borrowing and borrowing, no wonder the offers are getting more expensive and more expensive and more expensive, because it's higher risk and the client's going to go out of business, and they know it. And so you should know that and understand that, and not allow the client to believe something different. Right? If you really want to help the client, they should pay off that loan naturally. Make sure that they have solid numbers, no negative days, no missed payments. They do a little bit of credit repair, show steady cash flow, so that the next time they apply for a loan, they can get a better option, because they've shown their ability to successfully pay back a loan. They've earned and increased their credit. They've shown their responsibility and their trustworthiness as a borrower, and their ability to grow their business. That's what a lender wants to see. And so you need to understand as a loan broker how that works. Because if you're just trying to tack on another loan and overpromising and underdelivering, it's not going to work. And if a business owner is just stuck in a cycle of borrowing more and more expensive loans, it's only a matter of time till they default and go out of business. Your commission gets clawed back and it hurts the economy. The lender loses their capital. It's bad all around. Okay. Set realistic expectations. All right. Don't allow a client to believe something is available to them that isn't. Don't bait and switch clients, because it creates monsters. There are clients out there right now who believe that there's something available to them that isn't, and they're frustrated, right? The underwriting process is too invasive. The loans are too expensive, and I deserve something better. And even though I have these existing positions, I should get another position that should be even better. And you know, I deserve this type of rate or whatever. No, you don't, Mr. Client or Mrs. Client. And here's exactly why. And if you think you do, you're wrong. And if you want to go look around and again damage your credit because you've convinced yourself or allowed somebody else to convince you that there's something better, be my guest. You don't have to take a loan from me, but I'll tell you the truth, and it'll help you position yourself for the future. And if you do that, you may win over the client, because at least then they'll trust you. They'll believe, they'll say, at least this person's going to tell me the truth, and I can work with that, right? They may jump around and ask one or two other people what's going on and get slapped right in the face and realize that it's exactly what you said, proving you right, because they got an expensive offer. It wasn't what they expected. It was yet another inquiry on their credit, another broker that lied to them, and they'll remember you who told them the truth. And you may just win yourself a long-term client by doing that. So it's all about perspective here, people, okay? Also, manage your own expectations. You have to be the expert and know the outcome ahead of time and save yourself the headache. Imagine not knowing this information we're discussing right now and then having to consult a client with unrealistic expectations, or even worse, you expect an offer and will pre-sell something different than what the client will actually get. Is that going to work out for you? Are you going to put a commission in your pocket, right? Think about it. It's not. Don't put yourself in that position. Don't allow yourself to get your hopes up and put yourself in an unrealistic mindset for it to all blow up and then have that go from that high to that low. Don't put yourself in that position, because if it goes down like that and then you're all upset, it's nobody's fault but your own, okay? It's just I'm trying to save you from that experience, okay? Because I've been through it before. I have the scrapes, the cuts, and the bruises to prove it, okay? This is what happens as a business loan broker. We learn these lessons, we develop these scars, and they teach us so that doesn't happen to us the next time. And what I'm sharing with you now can expedite that journey for you so that you don't have to have that experience. Okay? So what I want you to walk away with, and I got this from Alaric Heck, with ad outreach. I'm not sure where he got it, but I love it. I think it's an excellent quote. So it's not something I came up with, but he shared it with me. I'll share it with you. I really enjoy it. And that is data equals intelligence equals money. And what I mean by that is you need to gather information, but then that information grants intelligence, and that can help you make a decision towards earning money. But if you think you're just going to grab data from a client and forward to the lender without grabbing the intelligence piece and expect that money's going to be the result, absolutely not. There's a disconnect because there's no intelligence. And assuming that the lender's job is to underwrite and qualify the file so they can gather intelligence, sure, you can depend on them depend on them to do that for you. But how does that help you? Is that a realistic, consistent business model and plan? Or are you just not in the know of what's going on at any given stage? How can you help clients if you yourself don't even know, right? So anybody out there who's a referral partner just forwarding deals to lenders, I promise you it's not how this business is done. Perhaps you signed up with a program where they are offered a blueprint or something telling you that that's the case. It's not. It's not. Anybody who's actually worked in the industry will tell you that. Okay, so with that being said, that'll do it for this topic. Again, thank you so much for following along. Good luck with your deals. I'll catch you in the next video.